Welcome to Conversations, Season 2 of the MTA Podcast Series, a weekly audiocast featuring interviews with leading investment strategists, geopolitical experts, and other key thought leaders, brought to you by the Market Technicians Association, and your host, Ed Carlson.
Wednesday, November 3rd, 2010. This is Conversations, the official MTA podcast series. And today's guest is Richard Arms. Dick Arms has spent nearly half a century following, trading, and writing about stock markets. Best known for his ARMS Index, or TRIN, his other major contributions to Wall Street methodology include equivolume charting, ease of movement, volume-adjusted moving averages, volume cyclicality, and a number of volume-based indicators. These tools are revealed and explained in his 6 books, the most recent titled Stop and Make Money. Dick has received many of the highest awards in technical analysis, including the Market Technicians Association Award for Lifetime Achievement. He has been inducted into the Traders Hall of Fame. Located in Albuquerque, New Mexico, as Arms Advisory, Dick advises a select group of institutions. He also writes a twice-weekly column for Real Money, a subsection of TheStreet.com. Richard Arms, welcome to the program.
Good to be on here. Hi.
Yeah, hi to you, and thank you for taking the time to join us this morning. Dick, we usually start these podcasts with a little personal background information. For example, where you went to school and how you made the transition to technical analysis, your first position as a technical analyst. Could you give us a couple of minutes of background?
Sure, happy to. Actually, I probably didn't come the way most people did. I didn't get here through school, really. I still don't have a college degree, but I really just got interested in the stock market. Actually, my grandfather once owned a brokerage firm in Worcester, Massachusetts, so maybe it was in the blood, but I just wanted to kind of get into the business. I was looking around for a job. I needed money. I was married, just out of the Army. And
about what year would that have been?
Oh, gosh, that would have been 1962, I believe it was, 62.
Okay. All right. So you got out just before Vietnam, or just?
I was timed it pretty well. I was after Korea and before Vietnam. So
all right. So you got out of the Army, and then what happened?
Well, I was looking for a job, really, and I started to check around with brokerage houses, and I was offered a job with this tiny little over-the-counter brokerage firm, 3 brokers, and I was the board marker, chalking the board and running the teletype machine to place orders. Everything went over teletype in those days. And I even typed up confirmations and stuff. But that's really how I started to learn the business.
Huh, how about that? Well, then how did you make the transition to technical analysis?
Well, that was a long way down the road, actually. After that, went to work for good firm, but one you probably never heard of, Hemphill Noise and Company in Boston for a while, and that led me to E.F. Hutton, and I was with E.F. Hutton for a number of years, and in the process came up with something called the ARMS Index. I was a stockbroker. I was peddling stocks.
Oh, okay.
Mile and dial,
Right.
But I got going on this. Actually, kind of interesting. We had new quote machines in our office, these new Quotron machines, and for the first time, instead of just a slip of paper that came out the side that gave you quotes, you actually had a small screen. I think it was like 2 or 3 inches wide. And on it, you could get advances and declines. And for the first time, advancing volume and declining volume.
Okay.
And we'd moved into a new office, so we were one of the first firms to get this new machine. And I started looking at it, and, advances, declines, advancing volume, declining volume. Kind of made sense to me to try to put it together and see whether the up stocks were getting their share of the volume or not, whether the down stocks were getting their share of the volume, et cetera, and came up with a simple calculation that became the ARMS Index, or TRIN. So that kind of got me started on technical analysis, just by happenstance almost. I was the first one to do it.
Well, and then how did you make the transition from being a broker to a full-time technician?
Slowly.
Slowly.
I was a stockbroker and doing technical analysis. So the next thing I did was dreamed up something called equivolume charting. And by then I had taken the Wyckoff course, which is what do they call it? Stock Market Institute, it was called. Maybe it still is. And they offered a course in technical analysis based on the work of Richard Wyckoff, which made a lot of sense to me. And that really swung me across to really thinking technically and led me directly into developing equal volume charting. And so I wrote my first book then.
Oh, really?
Yeah.
Okay. All right. Well, all right then. Let's move on. Why don't you give us an idea as to what the rest of us can look forward to after 50 years in this discipline? What does your typical day look like, Dick?
Well, I advise institutions. So mainly I'm sitting at a desk here in Albuquerque, New Mexico, surrounded by computer screens and with CNBC going and another computer beside me for some other stuff and 4 screens in front of me. And I'm just kind of watching markets and making phone calls and talking to people. But everything is entirely technical, and what I'm doing is I'm calling my institutional people when I see that there's something to talk about and just kind of pass my thinking along. So this is really part of what I provide to institutions. What they're buying from me is an advisory letter that goes out once a week on Sundays. And it's usually, about a dozen pages, but a lot of that's charts. So it's not as much writing as you might think. And it's just a look at primarily equity markets, U.S. primarily. And then I follow that up with the telephone as necessary. And that's really what these people are getting for their money. And that's my main thing. And then twice a week, I'm writing a column for TheStreet.com in which I'm also giving a short market opinion, and I'm also picking out some individual stocks for them, long and short. So that's good. So Tuesdays and Thursdays, I'm very busy writing my Street.com stuff. And over the weekends, I'm writing my advisory letter for institutions. In between, I don't have much else to do.
Okay, all right. Oh, Dick Arms, you're probably best well known for your ARMS index and the equivolume charts, and I would imagine that after all this time, you probably aren't real eager to answer any more questions about them. But would you mind sharing with us what you think are the most important things to know when using these methods, and what typical mistakes do people make when trying to use these indicators?
Oh, boy, I don't know. I think perhaps it's lack of flexibility. People are always saying to me, hey, on your index, what parameters do you use? If the 10-day moving average is below, 0.75, does that really mean that I need to be a seller? Or is it, if it's above 125, does that mean I have to be a buyer? And they don't realize that you've got to look at these things in context of markets and everything else that's around them, and that they're very, very helpful, good indicators. But I don't believe that anything is so good that you can just follow a number. Mm-hmm. And so I don't know if that answers your question.
Yeah, sure does. I think that's a great answer, actually. Quick question, and I know I'm going to feel foolish when you give me the answer for this, but in looking through your research that you sent, I noticed that you have got equal volume charts on the Dow. Now, how do you apply equal volume charts on the Dow when the Dow isn't traded? There's no volume to it.
What we're doing is we're plotting total market volume against the Dow high lows.
Oh, okay.
So you'll look in my work also there that I have the S&P, and there's no volume because there's no real volume number we use on that at all.
Right.
But, you can also get a volume number for just the stocks in the Dow if you want.
Oh, can you?
Yeah.
I didn't even know that.
Yeah.
All right. We're going to continue with Richard Arms in a moment, but first a reminder that on next week's program, we'll have Larry McMillan as our guest. All right, Dick, let's move ahead. Let's talk about cycles. I know you do a lot with cycles. For example, you really don't buy the idea of a presidential cycle, do you?
No, not at all. I mean, just that I've looked back and I can't find any correlations in there at all. But really, my cycle work is kind of put forth in a book that came out, gosh, I don't know how many years ago, called Volume Cycles in the Stock Market. And it's based on a kind of an interesting concept that nobody seemed to have really thought about before. It's my belief and my thoughts that stocks don't know what time it is. Stock markets only know what volume it is. So that if you have a move that's going to go a certain distance, it doesn't matter whether it takes 3 weeks or 3 months. X number of shares have to be accumulated or dissipated. In other words, you have the shifting of stock from hands to hands, and it's the number of shares that move that determines the length of the move and not time. So that puts us in a saying, well then, if you look at 3-week cycles or 6-month cycles, that somehow doesn't make much sense. Doesn't it make more sense to say, a stock tops out every time X number of shares change hands, or the market tends to have cycles that are based on volume? And when we use an equal volume chart, of course, then we're putting volume on the x-axis, so we can put a ruler to the chart and actually measure volume on the x-axis horizontally. Do you follow me?
I think so, yeah.
Yeah. So these cycles then, one cycle may be 5 months, one cycle may be 7 months, because during that 7 months you had lighter trading. During the 5 months you had heavier trading, but the tops and bottoms tend to come in the same distance apart on the chart, because the equal volume chart has volume on the x-axis. I don't know how familiar your people are, the listeners are with equal volume, but it's those little boxes. It's the idea that each day or each week, or whatever you're studying, is represented with a rectangle. And the height of the rectangle, of course, the high and the low, just like on a bar chart. But the width of the rectangle is the number of shares you traded. So a wide box is heavier volume than a thin box, that's all.
Okay, all right. Well, let's go back actually to the traditional idea of cycles, because I know you do look at what most of us would think of as cycles. How do you go about isolating and identifying cycles? Maybe, and if need be, you can talk more about the equivolume charts.
That's a tough question. I don't know. I'm just sort of an observer. I go back and test and work with and look at, and more than anything, I just kind of look. I don't know if I could really answer your question.
Okay. No, that is an answer.
Ecology, yeah.
No, I think that's a fair answer. Thank you. I appreciate your modesty on that one, actually. Okay, Dick, listen, every week we do these podcasts, and I always reserve a moment. This is sort of me getting paid. I reserve a moment to ask a question that I'm very interested in, regardless of what anybody else is interested in. So here's this week's Eds Question. I have been tracking a 15-week cycle in the S&P since March of 2009, which has just nailed the highs incredibly. I mean, almost, to the week every time. Mm-hmm. Now, my thinking is that when the herd turns and the market starts south, it probably won't be at a 15-week top, as a new cycle will become the dominant cycle. My question is, does that make sense to you? And if so, how do you prepare for different cycles to become dominant at different times?
Obviously, you're very oriented to the cycles, and you're thinking about time cycles here. You're asking me questions that really I'm looking at the volume cycles, and I'm looking at the repeats based on how many shares change hands. So I'm not sure I have an answer for you, really, Ed.
Okay.
I'm sorry, but
no, that's fine.
No,
that's fine.
I could go back and look and see how the correlations are on those things, but no, I don't really have an answer to that.
All right, that's fine. You actually have already addressed this next question, which is I wanted to talk to you about how you communicate with the consumers of your research. You talked about the weekly report. You make a phone call to the institutions. However, that did generate another question in my mind. Who, not the name, but maybe the title, who is the contact at an institution that you might pick up the phone and call with all the people there,
It varies. Generally what happens is it's somebody at a trading desk or in a position where they're watching markets fairly closely, who then relay what I'm saying to the other people. I'd like to have one contact in the firm, and usually it's somebody that's easily reached, who's on a desk or something of the sort, who is not the top guy in the firm. but is in contact with a top guy in the firm, or top guys. So if it's a hedge fund, it may be a guy on the desk who'll go running into the head guy and say, here's what Dick is saying right now. But that way I have a quick way, because when I get something going, something that I really need to talk about, I may talk to 15 or 20 people in just a matter of a couple of hours. As I'm seeing something developing that I think is important.
Okay.
And consequently, there are also times when I sit here for day after day without needing to talk to anybody. Depends on what's happening.
Sure. All right. We're coming into our last 4 minutes here, so let's shift gears. Why don't you share with us who you would say have been your greatest influences? Who would you point technicians to study and follow, and maybe you have some favorite books you'd like to share with us?
Well, of course, the favorite books other than my own I think everybody has to read Reminiscences of a Stock Operator. It's a required reading. The classic.
No, why do you say that? Why do you say that? We had somebody else on that said that as well. What is it about that book that appealed to you?
It's the psychology. It's saying
psychology.
Why do people act the way they do? It's looking not at markets as a mechanical thing, but as a response to people's thinking. I think it's a classic book that anybody who would be working for me would be required to read. It's just that good. Other than that, Richard Wyckoff I mentioned, because the Wyckoff work is straight technical analysis, and it's very heavy on the volume end of things. And, of course, volume is what I think is the key to the marketplace.
Sure,
so
right.
Wyckoff's work. But,
okay.
So those are some things. And I think my jumping off point really was Wyckoff's work. After studying his, then I started to think about other ways of representing the same things visually, and that led to equal volume charting and things. So these are all things
Dick, we're losing you. We can't hear you. Go ahead.
These are all things I'm looking at. And
okay.
Yeah.
All right. That's great. Hey, Dick, has the MTA played any role in your career?
Oh, yeah. Other than, of course, giving me this fantastic award that I think is probably the highest point in my career. It has just been great because I didn't know anybody in the business, and I was actually got a phone call once from a guy named John McGinley in New York after I'd written about my index and written a book or two. He said, we got this organization called Market Technicians Association. And he got me into it, got me speaking. I spoke at one of their first conferences, or your first conferences, on Cape Cod. Chatham Bars Inn. I don't know how many years ago that was. And I was a non-member then. And then, of course, they got me to join. And after that, when I went and spoke, they didn't pay my expenses anymore. But
okay. Hey, we're down to the last 60 seconds, but we can't let you go without asking you, what do you see for the markets in the either immediate, intermediate, or long-term future? Your choice.
Well, short term in here, obviously, it's overdone. Intermediate term, we're sort of in the middle of the big trading range that I've been talking about for a number of years. Back at the end of 1999, I said we were going to go into about a 16-year sideways move. And we've been doing that, and we're about midway in that trading range, and we look like we've still got a number of years within it. So on a very long-term basis, I think probably we continue to, in other words, we're in markets where you have to be willing to be a buyer and a seller. They aren't buy and hold markets. And I think that's very important for people to realize.
Yeah. Dick, it's been great having you with us today. Is there anything else you'd like to mention before we conclude?
No, nothing other than that people ought to go out and get my latest book called Stop and Make Money, because it tells you very interesting different ways of using stop orders, not to protect positions, but to enter positions.
Okay. Well, fair enough. Thank you very much for joining us today. Today's guest has been Richard Arms, and that wraps up this week's MTA podcast. From SeattleTechnicalAdvisors.com, I'm Ed Carlson, together with our recording engineer, Shane Squark in New York City. Say goodbye, Shane.
So long, everybody.
Okay, let's keep our stops tight. Good day.